Hello, everybody, and welcome back to week 2 of Business 1750, Personal Finance. So I'm going to go through the weekly overview and then talk a little bit about chapters 3 and 4, just like we did last week. The weekly overview, please do not forget, test number 1 is open this week, and it will cover the first 4 chapters, what we did last week plus what we're doing this week. This week we're looking at chapters 3 and 4, which chapter 3 is financial instruments and institutions, and chapter 4 talks about the time value of money. And there's 6 objectives that we're going to try to cover. It's in the weekly overview, 3 from chapter 3, 3 from chapter 4. Looking ahead, next week, we're doing chapters 5 and 6. We're going to, we're moving right along. But to do this week successfully, you need to, at the beginning in the weekly overview, it says review like chapters 1 through wherever we are up to PowerPoint presentations, because it moves so fast. You need to always look back every week. So last week we did chapters 1 and 2. This week we're doing chapters 3 and 4, but don't forget about chapters 1 and 2. Look back over them again because it comes so quickly. It'll be final exam time over all the chapters, and if you haven't looked back, you may forget some of the stuff from the beginning. So always look back. So review chapters 1 through 4, PowerPoint presentations. Read chapters 3 and 4 in the book, because the PowerPoint doesn't take the place of actually reading the chapter. There's more information in the chapter. Individually, you're going to complete the chapter 3 and 4 problem assignments, the chapter quizzes, and the continuing case studies for both chapters, and complete test number 1 on your own. And then there is 1 discussion board for the week. And that's how, if you recall, that's how we take attendance every week. So just be sure. And every week in the overview, and I think at the wrap up, I try to include the spreadsheet that is the little roadmap that shows you every week what's due and when it is due. So everything's usually due on Sundays. The only exception is the initial post for your discussion board is due on Wednesday. And then the last week, week 8, everything has got to be done on Friday because that's the last day of the class. So that's the only one where you have a short week. All right, so let's take a look at Chapter 3, Financial Instruments and Institutions. And some of this information that's in here, it refers to like checks and stuff like that. And I know that some of you may have never written a check before. It's very rare that I write them anymore. But it's still a thing. And if you work with businesses, I think, use checks more than people do anymore. But most of our transactions anymore are digital in nature. But financial instruments and institutions. 3 learning objectives: determine which bank products are best fit for your financial stage of life. And we'll look at the life stages. Learning objective 2, efficiently manage checking and share draft accounts. And so that's where your debit card, took the place of the check. And number 3, evaluate financial institutions and account types to determine which type best meets your needs. So the first thing we want to look at is our life stages. We all go through, according to the way the book has it broken down, 5 different life stages. The dependent life stage is, they listed up from baby, age 0, up to age 15. Because up until about age 15, you pretty much are dependent on your parents or your family or your guardians for everything. At age 16, most people can start getting a part-time job without like parental permission. And so the independent life stage starts at age 16 and goes through age 24. And this is as you finish high school, as you go to college, and as you start out on your own. You're independent, you're on your own. It's kind of assumed that somewhere but around age 24, 25, you may be settling down to, okay, sorry, I had to have a little interruption there for a phone call. But the independent stage ends somewhere around age 24, and the assumption is you're out of school perhaps and maybe settling down into a lifestyle where you are entering early family life stage, which means you may be married. You may not be married, but you're having a domestic partnership with someone, and perhaps even starting a family, so that you have children involved in your life and raising children. And they say that goes from age 25 to around age 40, and somewhere around age 40, if you had kids really young, they're starting to move on out and be independent life stage of their own. And this is what from age 41 to 65, the empty nest life stage occurs, and that's when your children are gone, and it's back down to you and your spouse, or you and your domestic partner. And then at the next one is retirement life stage, which is anything after age 66. The assumption is maybe you're winding down your career. It's time to retire and enjoy life and do whatever you want to do. But you think about it, the dependent life stage, you don't really need much money because your money is provided for you. The independent life stage, you're just getting started. So you're starting to build credit. You're starting to set up checking accounts. You're starting to purchase some small things. That early life stage is where you really start spending some money. You're out of school, maybe you're paying back student loans, perhaps you're buying cars, you're buying houses, you have children to take care of. You need more life insurance because what people are depending upon you. So that's a really expensive time. Plus, but you're making money, you're working. That's the assumption is this is your peak earning time as well. Empty nest life stage is things are starting to wind down, children are starting to go away, but maybe grandchildren are coming into play, and those can be very expensive. But you've probably already bought your house, or maybe you bought a big house and now you want to sell the big house and buy a smaller house. It's less money because it's just you and your spouse again. So things start to wind down a little bit, and then retirement life stage, you enjoy your money, you enjoy your life. It's a little bit more relaxed. So those are your different life stages. So in the dependent life stage, a lot of times we have things done for us. For example, when I was young, I had my father was a twin. He had a twin sister, and my aunt and uncle set up a small savings account for me because they didn't have any children of their own. And every month she put just a little bit of money in my savings account, just not a lot, but just enough to where it was kind of cool to have a little savings account. And I never touched it because it really technically, they were putting the money in, it was at their bank. I just knew that every month some money was coming in. And then when I got to be 18 and went away to college, I got that money, which was really nice for spending for different things. And but there's something that you may be familiar with. It's called a 529 plan or college saving plan, and this is run by the state. Every state has one, but you don't have to live in the state to contribute to that state's plan, is the way I understand it. So what you do is you set it up for another person or for yourself if you do it through your own self. But basically you set aside funds every month or every paycheck or what have you, depends on how often you get paid. And the money goes towards post-secondary education expenses. Now what happens if you set aside this money for someone like a child or a niece or a nephew or somebody, and then they choose not to go to college? The money can be gotten back. It's just, it's set aside for that particular purpose. A certificate of deposit, or a CD, is a safe instrument of savings where you purchase a certificate of deposit for a certain amount of money, and it has a fixed rate of interest that for like 6 months, a year, 2 years, the bank tells you how long does the CD, what's the life of the CD, and then you get that rate of interest, and it's guaranteed for the life of the CD. And then when it's time for the CD to mature, you are given the opportunity to start it over at the whatever the current rate is, or cash it out, or roll it over to another bank. You can move to another bank with it, and it just goes from that bank to the other bank, and you don't touch it. So a lot of times when you have a CD, you keep track of when it's up for renewal, and you start shopping around. Is there a better bank somewhere that could give me more money on my CD? And then you just roll it over to some other bank, or you roll it over and keep it active at the bank where it's at. So and you can add money to it. You can purchase more CDs. It's just a fixed rate. It doesn't fluctuate as much as the free rate that goes up and down on the daily. The prepaid tuition college savings plan that we talked about, the 529 plan. The 529 is a college savings plan. It's no lock on college cost. It covers all qualified education expenses, including tuition, room and board, mandatory fees, books, and if you need a computer, you can get a computer, so supplies. Many plans have contribution limits in excess of $200,000. That's not guaranteed by the state, but most investment options are subject to market risk. Your investment may make no profit or even decline in value, which is a little bit scary. It's no age limit. It can be for children or for adults, and no residency requirement. However, like I said, you don't have to be in the state where you purchase the 529 plan. However, non-residents may only be able to purchase some plans through financial advisors or brokers, and the enrollment is open all year long. A prepaid tuition plan works differently. Basically, it locks in tuition prices at eligible public and private colleges and universities. And the plans cover tuition and mandatory fees only. Some plans allow you to purchase room and board or use excess tuition credits for other qualified expenses. So the difference in the 529 plan is you can use it for tuition, room and board, other fees like buying your parking sticker or all that kind of stuff, and to buy books or computers. With the prepaid tuition, it's tuition, and that's it. If you're going to live on campus, that's your problem. You have to come up with that money and room and board and all that kind of stuff. The prepaid tuition plan, most established lump sum and installment payments prior to purchase based on the age of the beneficiary and the number of years of college tuition purchased. Many state plans are guaranteed or backed by the state, so there's a little bit more security there. Most plans have an age/grade limit for the beneficiary. It's usually for young people. It's not for like older adult learners. Most state plans require either the owner or the beneficiary to be a state resident. So if you're buying it in North Carolina, for example, for a North Carolina school, you're usually required to be a resident of North Carolina. And most plans have a limited enrollment period. So you could like say open enrollment from like March to August or something like that. I have no idea, but that's just an example. All right, so after you go over and decide whether you want to save for college, I would say if you're going to do that for a child, I would go ahead and start it young. There's no harm in starting one of those 529 plans and then having later the child decide that they don't want to go to college. You get the money back. So it's just money deferred. The independent life stage is usually when people start, like I said, usually around 16 or so, they start getting, their own part-time jobs and stuff. So you open a checking account. You start using debit cards and, online payment systems. Generally, you have a checking account with a debit card. I would go ahead and open a savings account while you're there, and put a little bit of your money in the savings account. It's a concept we talk about called paying ourselves first, which will come into play in a little bit. But electronic online banking and bill payment services, perhaps you are dealing with some sort of a student loan because it goes from age 16 to 24. So as you go into college, maybe you don't go to college, but you've bought a car, so you have an auto loan. You may even have started work and started doing an IRA, which is an individual retirement account. Do you do Roth or traditional? We'll talk about that. And you get involved with credit cards, where you're borrowing money to spend. So, which is different from, of course, from using your debit card. So, understand your debit card is tied to your bank account, and when you don't have any money in your bank account, your debit card does not work. Credit cards, however, you are borrowing money, and there is a limit on how much you can borrow with a credit card, but understand you're going to pay it back with interest, and interest is any fees charged for the use of the money. Banks don't give money and collect it back just for fun. They do it to make money. And so if you hold a balance on a credit card, let's say you get a credit card and you have $500 of a balance on there, and at the end of the first month you pay $100 on your credit card. Well, you still owe $400 plus the interest on the $400. And if you pay a late payment, there's a late payment charge on the $400 and it starts to add up. If you just pay the minimum payment, you may never get out of debt because it just keeps adding up and adding up and adding up. I learned that the hard way when I was young. And for the longest time, I did not use credit cards at all because I just really got into deep trouble with them and had to kind of get a bailout on it, and it was a little bit embarrassing. But I got myself right on it, and I do own credit cards now, and I pay them off every month because I don't want to get back into a situation where I am behind and owing money to a credit card company every month. I use them to purchase gas. I use them, like I have a BJ's warehouse credit card. I buy all, if you've ever met my dog Luna's dog food comes from BJ's, and my gas comes from BJ's because you get a substantial discount on gas and you get cash back for buying products there. So I use that wisely, and every month I pay that credit card off so I don't owe them anything in interest or late fees. And it's just like using money, except that I'm just getting money back and I'm getting a discount on my gas. So that's the way I decided to use my credit cards. So I have another credit card that gives me mileage on airlines, and then I have one with my bank that really doesn't do anything. It's just there. So, but let's talk about going to school, because you're in school, so now we know subsidized versus unsubsidized federal student loans. A subsidized federal student loan is the interest is paid by the government and maintaining half-time status or greater, and so you don't have to pay anything, you don't have any interest that starts until you're done with school. It's subsidized. So let's say they got some really easy numbers here in the PowerPoint. They say you borrowed $10,000 and it accrues $1,500. Well, that $1,500 is paid by the government for you while you're still in school, at least maintaining half-time status or greater. And so when you graduate or when you go below half-time status, you owe what you borrowed, the $10,000. And 6 months after you graduate, the bill's going to come due, or go to below half-time. The bill's going to come due. So you get 6 months to figure it out and get yourself a job, and then you get a bill. The unsubsidized student loan, the difference is they're not going to pay that interest while you're still in school. So rather than coming out and owing exactly what you borrowed, you come out owing what you borrowed plus any accrued interest. And so if you're looking at the PowerPoint, same problem, $10,000 borrowed plus $1,500 in interest. They didn't pay anything for you while you were in school because it was not a subsidized loan. So you start out owing $11,500. And other than that, it's the same. The payment starts 6 months after going half-time or below or graduating. So that's really the big difference. The subsidization carries over and takes care of the interest while you're still in school. So the independent life stage, another thing you might want to talk about or think about is as you go into your work life, it's never too early to start thinking about what happens when I retire. Because the sooner you start paying into some form of a retirement plan, even if it's an individual retirement account or a mutual fund or however you're going to handle it, you can put less money in because you're going to be paying over a longer period of time. So an individual retirement account is funds set aside to be drawn after age 59 and a half with no penalty. And a traditional individual retirement account, or IRA, it reduces your taxable income because what you do is you give your money pre-tax, and money and interest earned grows tax deferred until the year it is withdrawn. So you won't be paying any taxes on it until you take it out, okay? A Roth IRA is you go ahead and pay the taxes up front. Contributions are made after taxes on your income, and the money contributed grows tax-free, and withdrawals are tax-free. So it depends on what you want to do. If you want to go the traditional route, you go ahead and put your money in pre-tax now, which would lower your taxable liability as you're paying in. but then you pay the tax as you draw it out. So you can pay the tax man later. The Roth says, go ahead and take the taxes out of it now. Then when I retire and get my check, I don't have to pay taxes then. Either way, 59.5 is the magic number. Once you hit 59.5, you can withdraw without penalty. Just depends on whether you have to pay the taxes or not. If you withdraw it early, there's I think it's a 10% penalty that on the money that you take out. But you can take it out early and just get a little hit on it. So, can you switch? You can switch it. But then what will happen is whatever you paid as a traditional IRA, you would still owe a prorated tax amount on that amount of money, and then what was put in as a Roth would no taxes on it. So you would just like stop putting in on your traditional and start a Roth. Okay. The early family stage. This is when you're working and you're out of school. You're 24 to like 40. A lot of concerns here are mortgages, buying a house, other loans, other cars, 401k plan, again, retirement thinking, home equity loans or home equity lines of credit, which is called a HELOC, home equity line of credit, a HELOC. What is that? It's an amount of money that you can borrow based on a home that you own, and you can borrow against that. The home is your collateral. Couldn't think of the word for a second there, sorry. The home is your collateral, and it's a line of credit. It's not a loan in terms of, like, let's say the house is worth $125,000. You don't get the whole $125,000. You could borrow 20 of it and you still have $105,000 left, and then you pay that back. So it's a line of credit, almost like a credit card, but it's your house is on the line. So most people who you get a HELOC, they use it for what? Home improvement. I need new carpeting all throughout the house, or I'm taking up the carpeting, I'm putting down flooring, or it's time to rewire because the house is getting older now and I need to rewire it because to get it up to code. There's all kinds of reasons to get a HELOC, okay? But you just pay it back like a credit card. It's almost like having another mortgage. You just owe the bank money back, and because they've given you money against the equity, the ownership of your home. Now, if you don't own anything in your home, if you don't have any equity is what do you own of your home. So let's say you're still paying on your home, it's $125,000 value, but you've only paid $50,000 of it off. You still owe the rest, the other $75,000. You can't borrow the whole $125,000 because you don't own it. You can only borrow up to what your equity is, how much ownership you have in the property, okay? You also, over and above your independent, life stage, you keep your checking account, you keep all the electric banking services. You're probably paying back your student loans. You're probably paying back for your first car, unless you bought a fairly inexpensive car and kind of paid it off. Your independent life stage credit cards, any debt is held over that you've gotten yourself into, and hopefully you maybe have set up some sort of individual retirement account, but through your work is usually a 401k. A lot of times you pay in, your employer will match a certain percentage of it. It's very rare that you get a deal where they pay everything and you don't have to pay anything. That used to be very traditional and very normal, but that has moved away into a land where we contribute, they contribute, and so it's usually matching. And so that's the early family stage, and it goes on with the next slide to kind of explain what we just talked about. And with mortgage loans, understand there's lots of ways. The mortgage is the loan that you get when you buy a home. It can be it's considered a long-term loan used to buy real estate or real property, and the collateral is the property until the loan is paid. So if you get a mortgage, and just like with an auto loan, if the car is the collateral until it's paid off, if you don't pay your auto loan, they're going to send a repo man out to come get your car and take it away. Obviously, they can't take away property. It's on the ground, but they can get you evicted and foreclose. The term is foreclose. The bank will foreclose on the property. The property will revert ownership back to the lending institution. The property will be sold. It's a court order sale, usually an auction of some sort, and whoever wins the auction takes over the loan, and it's their property now, not yours. So it's don't get yourself over your head in cars or in homes. So you can either get a fixed rate on your mortgage, which means it's your interest is going to be this amount from payment 1 to payment whatever, 15 years down the road, 30 years down the road. I don't know how long you can set it up in increments, different increments, depending upon how long you want to pay. The longer that you pay, the lower the payment probably is, because you're spreading it out more, but you're going to pay more interest over time, which we will get into in chapter 4, the time value of money. You can also get what's called an adjustable rate. An adjustable rate is it's not fixed down to where it's the same rate all the time. It fluctuates with what the Federal Reserve charges. Now, what's the advantage to that? Well, if the interest rate by the Federal Reserve goes down, your interest rate's going to go down on your home loan. The downside of it is if the interest rate shoots up, so will your interest rate. So it's a little bit risky, but hey, some people, some people like to play that gamble. I don't know. When I had a home loan, it was a fixed rate, and we also have what's called a balloon payment, and it can be done at the beginning or at the end. You can put down a huge payment at the beginning, a big balloon worth of money, and then that cuts down on your monthly payment until you just pay it off. Or you can have a little bit lower monthly payment with the understanding that at the end you're going to put a big balloon payment at the end. If you've had me for class and we've talked about finances, I know I've talked about it in some of my classes. I had an aunt who ran several H&R Block offices in South Carolina, and so she got most of her money for the whole year between January and April during tax season. And so every year she had a mortgage, but every year she only paid one payment, and it was due on April 15th, and she paid her whole yearly mortgage in that one balloon payment, and then she didn't have another mortgage payment till the next year. So you can set it up for different things, just depending upon your life and what you can work with your bank. So it's interesting how people set up payments. Just avoid foreclosure, because it affects your credit. It's kind of like bankruptcy. It follows you a little bit, and you don't want to have no home to live in. You want to make sure to be within your means. So we said a home equity loan is a lump sum loan secured by equity in the house. Back to the example, if you bought a $125,000 house, and I'm saying that for easy math. I know houses are more expensive than that. I'm just doing the math, easy math. And you've paid in $50,000 of it. You could borrow up to $50,000 against that house, just like we talked about with the HELOC, which is a line of credit. But you cannot borrow more than what you have in the house. Okay? A home equity loan, lump sum, get it once, secured by equity in house. A HELOC is a line of credit, a little bit more flexible, where you say, okay, I'm going to buy some boards and hire a person to put a deck on the house. That's going to cost this amount of money. I can use that amount from my HELOC, and I still have $30,000 left. So it just depends. So sorry, I was getting choked there. Investments in your early life stage, there's a wide range of opportunities that you can use. Obviously, savings is very safe. Savings is, you're going to not make as much money, but it will grow, but it will grow slowly. Less likely than having a stock or a bond that goes up and down daily. And then there's money markets that you can invest in, money market funds, which is where, you have a portfolio, an investment portfolio, and you have a person who helps you, like a stockbroker or somebody that helps you trade and manage your money. Money market accounts is MMDA, money market accounts, and other kind of money market accounts are mutual funds. These are all investment opportunities where you turn your money into, usually with a broker like JP Morgan. I'm looking it up on the internet to see. I was looking at some different companies, JP Morgan, Chase, Fidelity, Price. There's all kinds of investment firms that would be more than happy to help you with your money. Your local bank, whoever you bank with, you can do money market accounts through your bank. You can buy stocks. Stocks, like I said, are a little bit more volatile because they change every day. The stock market, if you've been following, if you ever follow the stock market, that goes, sometimes it wildly goes up or wildly goes down, and then it recovers. And a lot of times I think that people in the stock market panic. I've seen, like, you see a news story and it goes, stocks are expected to fall based upon blah, blah, blah. And I'm going, oh, they're going to fall now because you just said it, So you just have to be careful with stocks and bonds. What you want to do with, what I've always been told with stocks and with bonds to a lesser degree because it's more guaranteed. But don't ever put any money into the stock market or into the bond market that you can't just consider it spent, okay? Because if you're putting your rent payment or your home mortgage payment and you're writing it on the stock market, it's the same as taking it to Vegas and gambling with it. It may pay off or it may not. And so any money that you put into the stock market or into the bond market's safer because it's government backed. You're buying long-term investments through the government, but consider it spent. Don't bet the farm on the stock market, because if it goes down and takes all your money's gone. It doesn't respect the fact that this is all my money. The stock market doesn't care. They're gonna, they go up and they go down based upon what's going on in the world, what's going on with the government, what's going on all over the place. So what you want to do is if you want to be in the stock market, I'm not saying don't do it. I'm just saying please be careful and don't put money in the stock market that you can't afford to lose, because it's a thing. All right, so after the kids are grown up, and somewhere around age 40, according to our little chart here, you hit the empty nest stage. You've done the whole savings accounts and the 529 plans and your CDs. You may still be rolling those CDs over because you haven't hit 59 and a half yet. You got your checking account established. All of your electronic banking is on point. Hopefully, maybe your student loans are coming close to being paid off, as is your auto loans, and you've got your IRA set up. Your credit cards are on lock. You set up your 401ks, and your house is maybe paid for or soon to be paid for. And, maybe you've taken a home equity line of credit and maybe taken the family on a cruise and you're paying that back because you can use it for other things. It's just be careful what you use it for. You've gotten yourself some investments depending upon what it is that you want to do. And now you've moved to empty nest life stage. The children are grown. Hopefully they're moved on and now they're in their own independent life stage. And, now you're free to maybe make some additional investments, maybe do some charitable giving, because you can get some tax breaks from that. And plus, it's a nice thing to do to give some charitable giving. You start to slow down a little bit. You continue on with your savings and your mutual funds and your money market accounts. Maybe buy some more stocks and bonds. maybe invest in some more real estate. The suggestion from the textbook, maybe a vacation home. Get yourself a place at the beach. Get yourself a place in the mountains. I don't know, wherever you like. My parents did not buy a vacation home. They bought a motorhome and went driving wherever they wanted. They went all over the country in that motorhome. And so that's how they invested some of their money into, rather than in real estate, they invested it in a motorhome and took it wherever they wanted to go. This is now a really great time to start trust funds for your children or grandchildren, or nieces or nephews, depending upon, like me, I don't have any children, so I would go nieces or nephews. And if you haven't done so, it's time to start thinking about your estate planning. What's going to happen when you leave this world, okay? And nobody likes to think about it, but it's a thing that you need to think about in terms of what's going to happen when you're gone, okay? And the last area of life is the retirement stage. And the one suggestion that they have in the book is what's called a reverse mortgage. And that's kind of interesting. But a reverse mortgage is you borrow from the bank. It's kind of like a HELOC or a home loan. You can either get a lump sum or get a monthly amount from the bank up to the value of your home. Okay? And they are basically paying you, like I said, either monthly or in one big lump sum, the value of your home. It is secured by the value of your home, and the loan is paid in full from the proceeds of the sale of the house when the last homeowner dies or moves out of the house. So what happens is, at the end of this situation, if you're the homeowner, you've gotten this money that's valued out of your house, right? And when you die or when you move out to live somewhere else and the home is going to be occupied by somebody else, the bill becomes due. And how does that happen? Well, if your children or whoever is going to inherit your property, they either owe the money back to the bank or the property is sold and that money goes back to the bank. So what a lot of people do is they get a life insurance policy early enough or whatever, where they could get the value of their home, get it back, and then when they die, the life insurance, that the money that the children get would repay back any reverse mortgage loans, and that so they get to keep the house, and you get buried, and you have enough money to all your final expenses, your burial, maybe leave them a little bit of money. I don't know what you want to do with it, and pay off any, like the reverse mortgage would be one of your final expenses. So any credit card bills, anything that you leave behind, that's what life insurance is all about. And honestly, they never mention life insurance, but I'm going to tell you, I would go ahead and get life insurance I've had life insurance all my life. I would say get some life insurance during your independent life stage when you're young, and then beef it up as necessary once you enter early family stage and you have children. Because what you want with life insurance is money that you don't usually see your life insurance, your heirs see it. So what you want to do is have a landing place for your family should you unfortunately pass away, where your spouse and any of your children could continue to live after you die. In fairly comfortable situations. So it'd be enough to bury you or to cremate you if you're going to prefer to be cremated or whatever. I had a friend whose mother got buried at sea. That was interesting. But anyway, but your life insurance is important, and I would say get it early. Because the longer you wait, the more expensive it's going to be. Because the older you get, the more likely it is that you have some kind of a health condition, and the more that you have health conditions, the more expensive it's going to get, because they're not going to want to insure you with a health condition because it's more likely you're going to die. So get it while you're young. Get yourself a nice insurance policy, a life insurance policy, and go ahead and pay for it. You can get term life, which is usually for 10 years, and then at the end of 10 years, the payment is the same for the term of the policy. And then let's say it's at the end of the 10 years, it will reevaluate at that time. Of course, you're 10 years older, it will go up. Maybe they'll insure you for another 10 years, or you can get what's called whole life, where you pay the same amount and you pay it until, like I think mine is, I'm at the point where they just asked me, did I want to up mine, because I think it'll last until I'm like 88 or something like that, and I don't think I'll be here at 88, but we don't know. Anyway, so you can have a whole life insurance where it's the same amount of money up to a certain point, and then like I said, I've hit an age where they're like, well, if you'd like to have it extended until you're like 100 years old, pay us a little bit more money. So it's up to you. So, but please don't ignore the importance of life insurance. So it goes on about what different kinds of accounts that you can have at a bank. You can have a checking account, which is at a regular bank. Money goes in from your pay or whatever. How you put money in from, somebody gives you a gift, Christmas money, birthday money, whatever, you put it in your checking account. If you go with a credit union, a share draft account works the exact same as a checking account with a commercial bank. It's just through a credit union, but they call it a share draft account. A commercial bank is a financial institution that accepts deposits and uses the funds to provide private business and personal loans. Most banks that you think of are commercial banks. And a demand deposit account is any transaction amount that is payable on demand. You can have a credit union. A credit union is a nonprofit institution that it serves a special population. Around here in Fayetteville, North Carolina, we have Fort Bragg Mutual Credit Union. I guess it's back to Fort Bragg. It was Fort Bragg, then it was Liberty. Now it's Fort Bragg probably again. We have Navy Credit Union. We have, I am a part of the State Employees Credit Union because prior to coming to work at Methodist University, I was a state employee through the K-12 school system, and so I still qualify to bank there. So you have a common affiliation is how it's put in the book, and that qualifies you to be in the credit union. You were in the military, you were in the Army for Army Credit Union. Fort Bragg Federal Credit Union is for anybody that works for the federal government. Navy is a U.S. Navy. I'm sure there's one for Coast Guard, Marines, all the different branches, Air Force. USAA is United States Armed Forces or something like that, affiliate. So it's anybody that's been in the military. That's a credit union. You got to qualify to be in a credit union. A negotiable instrument is something you may never see because the most simple one is a check. Like I said, businesses still use checks more than people do, individuals. But there is an example of a check in the PowerPoint and in the book, and it has lots of information on it. It's dated. It's how much it's written for. A specific amount of money is written on it. It's signed by the person who owns the account and is made payable to another party. So, for example, the example that's in the book is from May 16th, 2016, and paid to the order of College University, $500 and no $100s, $500 and no pennies. And then you write it out in words, $500 and no 100s. And if you're going to write a check, the number and the words have to match. If the number and the words don't match, they're going to go with what's written in words. Okay? And then there's a little line that says for, and they've got tuition, and it's signed by whoever Smart Sam might be. And then there's the American Banking Association check routing number, and that's every bank has its own number to say this is from this bank, and then your account number is who you are at the bank. So the ABA check identifies the bank, and the account number identifies you, and then there's a check number, and this is check number 001 according to the PowerPoint. So Smart Sam, this is the very first check, wrote to College University for $500 for tuition. And then you get well, I get mine electronically. I don't get mine in paper anymore. But you have a checking account statement, and on it, it has the account number. It has what is the period of time that this statement covers. It has a small summary of what was there when the period started, how much money was deposited, how much money was withdrawn, and were there any service charges for a final balance of whatever it is. And then below it, it goes into detail. Here's the check numbers, the dates paid, any maintenance charges is kind of in a block form, and then it goes through and literally shows you every individual check. Also ATMs and deposits. So it does withdrawals, deposits, and then ATM locations used. Where did you go to use the ATM? Why is that important? Well, if somebody gets a hold of your card, they can get a hold of your money. And if you're going to dispute something, you have to see what is yours and what is not yours. The faster that you start disputing these anything that's not supposed to be on your checking account, the faster that it will get taken care of, and the less likely it'll be that the bank says, hey, it's your problem, it was your money, why didn't you report it? I have it set up with my bank that if anything is $50 or more, I get a text notification from my bank saying, hey, $50 or $60 or whatever was put to this purpose. Is this an okay transaction? And you can set that for any limit that you want. And then if you were maintaining a checkbook, they have a picture of a check register where this is what you write to compare to when you get your checking statement. It's a little booklet with the checks, and you write in the check number and the date, and who you wrote it to and what it was for and how much money and what the balance was, and it's like a little ledger. It's like a little spreadsheet. You have an amount for withdrawals and an amount for deposits. Okay. And it talks about reconciling your checking account and why is it important to do that. Like I said, you need to know how much money you have in the bank. My mother being a bookkeeper, she would get theirs down to the penny every month. I'm not going to lie and say that I do that. I don't do that. I look at it and I go, yep, that looks right, that looks right, that looks right, and we go with it, Some types of checking accounts that you might want to look into. Basic checking. Usually there's a fee. It will say, there's a fee for every month, and if you write over so many checks or have so many ATM transactions, there's a fee per transaction. It could be that, that you can use this certain amount of ATMs in this network, like the Star Network or whatever, and then if you use banking, if you use an ATM that's not in our network, there's an extra fee. You do get a debit card. Some checking accounts give you a little bit of interest on it, like a savings account, which is nice. But your debit card, a lot of it either has a Visa or a MasterCard logo on it, and you can use it as a credit card or as a debit card. The only difference really is with debit cards, you've got to put your PIN in. With if you use it as a credit card, a lot of times it'll ask for it'll either ask for the zip code where your bill goes, or it may ask for nothing, just depends. But it's not really, you're not borrowing any money on it. If you're out of money in your checking account, it still won't work. Okay. However, there is a thing called overdraft protection, which is nice. If your bank offers that, you might want to look into it. If you run short and you have some savings, it will take some money out of your savings to cover, it saves you money in overdraft fees, saves you embarrassment. Just be careful with that. Online bill pay, I think, it's become very common. I use that more than I do anything else. You can use like PayPal, ACH, Bill Direct, Bank Draft. Basically, you can just set up automatic payments where it just comes out every month straight from the payee. You can do that with medical bills. You can do it I do this with my electric bill. I have it set up to where it's the same amount every month on an equal payment plan. And Same thing with my, I have natural gas. My natural gas bill is the same thing every month, and it comes out automatically. I never even have to worry about it. They just send me a statement, an email that says, hey, it sends one. It says, hey, on this date we're going. Oh, my car payment's that way too. On this date we're going to charge you this much, and on the day that it's charged, they go, hey, we charged you this much, like we said we were going to do, and it just keeps you up to date on it. And basically, it talks about different types of financial institutions: commercial banks, credit unions, savings and loan or savings institutions, and insured accounts up to $250,000. Commercial banks are for-profit and are owned by stockholders, and they can be state or federally chartered. It can be large U.S. bank that's like First Citizens or Chase Manhattan or something like that, or a small hometown bank, like the Lumbee Bank here in North Carolina. It's based out of Robinson County. It's a small bank. Specializes in loans to businesses, but can also offer a wide range of products and services for consumers. This is where most people do their banking. We talked about credit unions. Credit unions are not for profit. They are member owned via a common bond. And so that's why it's called share accounts. As a member of the credit union, you partially own the credit union, and they're usually small compared to commercial banks. And then they have something called savings institutions, which is savings and loans, and thrifts. Basically, these are not banks where you have a debit card. These are where you go to just save money or to borrow money to get mortgages or auto loans. The accounts for banks are insured by the Federal Deposit Insurance Corporation, known as the FDIC. Sure, if you've heard of commercial for a bank, it mentions that it's insured by FDIC. And the National Credit Union Association, or NCUA, it provides the same thing for credit unions, provides up to $250,000 of insurance to account holders if a financial institution declares bankruptcy. And basically what that means is if the bank goes belly up, your money is safe up to $250,000. And you'll get it banked. It's insured. Okay. So, what do you look at? In terms of finding the right institution. Well, convenience. Is it nearby where you live, or are you going to have to go a long way to go to a bank? What products and services offered do you need? How much does it cost? Do you have to have a minimum balance? How much does each transaction cost? What are the overdraft fees? Any other fees involved in it? Where does my money going to go? And there's a product and service comparison checklist that you can look at in the book, and it's also on the PowerPoint. And when you start looking at banks, you start maybe ranking them. They suggest rank number 1 is high, low is number 10. And you start looking at hours, evenings, weekends, what's available, locations. Can you get safety deposits? Can you get a Visa or MasterCard available? What's their home loan rates? What's their auto loan rates? All that kind of stuff. And you rank them, bank number 1, 2, 3, 4, whatever. And you kind of compare. So that's chapter 3, looking at the different things. It took a long time. Let's look quickly at chapter 4. Chapter 4 talks about the time value of money. And we're going to look at how paper currency gets its value and how the distribution is managed. Compute annual percentage yields from simple and compound interest rates. And calculate future and present value of lump sum. Let's talk about money. What gives the US dollar its value? Used to, it was gold. But since the Great Depression, we have not really been on a gold standard. What gives the US dollar value is, the amount of credit that we have in terms of money in the world. In fact, I want to look it up right now so I say it right. Investopedia says 3 flat factors that drive the US dollar. It's our economy. Or do we have a strong economy or a weak economy? Supply and demand. Are we having, do we have products that other people all around the world want to purchase, or are we purchasing from other people? When the U.S. exports products or services, it creates demand for dollars because people need to pay us in dollars. So if we're exporting more than we're importing, then we have a strong dollar. If we're importing more than we're exporting, the dollar is a little bit weaker. So that's number one. Number two is sentiment. When foreign investors buy back their local currency due to market turbulence, it dampens the dollar. Increasing unemployment may weaken the U.S. economy and consumption may slow. The U.S. may face a dollar sell-off where global investors return the cash from the sale of bonds or stocks to return to their local currency. So what do people think about us? Do they see us as strong, as a good partner, or do they feel like that we're risky? And last but not least, market indicators. What's our gross domestic product looking like? What is our other economic indicators such as inflation and unemployment and government statistical analysis, and what are we doing with our money? Those are the three factors. So market indicators, sentiment, and supply and demand are the three things that give us value as dollars. So we talk about compound interest, and the quote there is, "The most powerful force in the universe is compound interest," by Albert Einstein. Basically, compounding of interest is the process by which investment increases over time by earning interest. Just like when I talked about paying off interest on the credit card, and how if you don't pay off the whole bill, the interest continues to grow larger and larger. When you save money, you get interest back, and the more you save and the longer you leave your money there, the more interest you get back. So the annual percentage rate, or the APR, is the rate charged for borrowing or made by investing. It's also called the stated rate. And the annual percentage yield, or the APY, is the rate of return. So the annual percentage rate is what are you paying in interest, and the APY is what do you get in interest if you are receiving interest. So some simple interest versus compound interest. Simple interest, if you deposit $1,000 on January 1st, it's 1,000 plus, at 12%, it's 1,000 plus 1,000 times 0.12, so at 12%. And so on December 31st, you get $1,120. So, but compound interest, still $1,000 at 12%. It's 12% 4 times because it's compounded quarterly instead of compounded annually. Okay, so you get 3% per quarter. So basically, if you deposit $1,000 on January 1st and the interest is compounded quarterly, you have 1,030 at the end of the first quarter, 1,060 at the end of the second quarter, 1,092 at the end of the third quarter, and $1,125.51 at the end of the year. So you make $5 extra and 51 cents. So that's just on $1,000. So if you have more, just understand exponentially it grows faster. Your money grows faster the more you compound it. So when something's compounded quarterly, it's 4 times a year. Think about compounded monthly, that's 12 times a year. Compounded daily, 365 days out of the year. So, the more that something is compounded, the more it grows. And we have another thing that on the PowerPoint that explains the APY, compounding it quarterly, and that's how much you, basically what I just said, you get extra money. You made $125.51 if it's compounded quarterly, which is technically 12.55% if you do it annually. So you get a little bit more interest the more you compound it. The equation, APY equals 1, in parentheses, 1 plus R to the N exponential minus 1. R is the stated annual interest rate, and N is the number of times compounded per year. So the annual percentage yield is 1 plus the rate divided by the number of times compounded by the year raised to the number of times compounded per year power minus 1. Ugh. So if you hadn't gotten one, remember I said at the beginning in the very first one that there's some financial online calculators. Go ahead and get one, because you're going to need one for this type of math. And so it's just, the quarterly compounding is more attractive than yearly compounding, monthly more attractive than quarterly. So what you want to do is look at, how many times is my money going to be compounded? The more that it's compounded as you owe money, the more money you're going to owe. The more that it's compounded as you're getting money, as your yield, the more you will yield. So the time value of money is based on the idea that $1 now is worth more than $1 in the future, even after adjusting for inflation, because $1 now can earn interest or other appreciation until the time the dollar in the future would be received. So what we're saying is, if I give you $1 today and you go ahead and put it in the bank, it will be worth more than $1 tomorrow, and even more the next day. And if I'd waited till next week to give you that dollar, you'd just be starting with $1 then. So $1 now is worth more than $1 in the future, even if you adjust it for inflation, because you've had time to invest it and get interest on it. Does that make sense? I hope so. And there's a chart that's in the book, and it's on the PowerPoint, about the time value of money example. And we have Smart Sam. He's the guy that wrote the check, if you understand what I'm talking about. Remember, he wrote that check for us to college, university, whatever. He starts saving at age 19, as does Dedicated Dave. But Wild Willie waits until he's age 29 to start saving. And they're each putting in $2,000, I guess, a year. That's what it looks like. Dedicated Dave looks like he's making more money, because he must be either with a different compounding system. Smart Sam ends up at age 31 with $42,425.42. I know why. I see the difference now. Smart Sam started paying at age 19, and he paid until he turned 28, and then he stopped paying. But he still kept gaining interest on the money because it's in the bank. So at age 31, he's got $42,425.42. Dedicated Dave also started at age 19, putting in $2,000 a year, and he did not stop. At age 31, he's still putting in $2,000 a year, and he's got $49,045.42. But Wild Willie in the middle, he's like, nah, I'm going to play a little bit longer. And he didn't even start saving any money until he turned 29. So at age 31, he only has $6,620 saved, because he started late. That's the future value of money. All of it is $2,000 a year. But look at how it grew, because they started earlier. And that's what I remember I said earlier about starting young for retirement. Oh, it goes on to the next page. Smart Sam at age 70, he stopped depositing money at age 28, okay? Remember Smart Sam? At age 70, he has $1,745,584.65 for an investment of $20,000, okay? Dedicated Dave kept paying his money in every year until he reached 70. He has $2,820,858.64 for an investment of $104,000. Wild Willie did the best he could. He started late, and he still ended up with over $1 million, $1,075,273.98 but he had to put in $84,000. So Sam, who stopped investing at age 28, came up in second place in terms of money but he only invested $20,000. Dedicated Dave put in $104,000, but he came up with $2 million. And Wild Willie, he paid $84,000 he paid $64,000 more than Smart Sam to have about $6 $600,000 less dollars in the bank. So the time value of money, start now. You know, and just save a little bit. You don't have to save a lot. $2,000 over a year, if you get paid, let's say you work a job and you get paid every week, all right? And there's 52 weeks in a year. That's $38.46 a week per paycheck if you get paid every week. If you get paid every 2 weeks, it is $76.92 every 2 weeks. And if you got paid once a month, it's $166.67 a month out of your paycheck. And if you're like Smart Sam, you could stop at if you start at age 19, you could stop at age 28 and still have $1,745,584.65. And that's if you decide to stop at doing it for 10 years with $20,000 investment. It's not bad. So we talked about the concept of paying yourself first. I mentioned it earlier. Making compounding work for you. Set up, when you start getting your paychecks, set up what's called pay yourself first, automatic transfer to savings and investment accounts. You can tell it. I've done it here at Methodist. You can do it. All they're doing is when you set up your pay, you say put this amount of money into this account, put that amount of money in that account, and part of it is your savings and part of it is your checking. And that way you never even miss it. If you don't see it, you never miss it. It's just going into the savings. Okay? Treat it like a bill. Just say, okay, I owe, if it's weekly, I owe $36 and change to myself for savings, and just go ahead and get it taken out of your paycheck. Start small. Increase the amount a little bit annually as you make more money as necessary, but then don't touch the money. Make it a true savings account where you're saving for retirement. Of course, if a huge emergency happens, you'll have to make the call on your own. But don't touch the money unless you have to. Don't think, oh, I could go grab some of that money and grab a pizza. Don't do that. Don't do that. Just go without, or figure it out. Buy something else less and buy your pizza with your regular money. Okay. Some terms that go with the time value of money. Future value is the projected value of an asset based upon the interest rate and time in the account. So you're looking into the future. We can do an equation to figure that out. The present value is the current value of an asset to be received in the future based on the interest rate and the time in the account. So what is it worth today, versus what will be in the future? A lump sum is a single one-time payment, and an annuity is a series of equal payments made at equal intervals over time. So like every day, every month, every year. So to calculate the future value of money, it's FV is future value equals PV, the present value, and then in parentheses 1 plus the interest rate raised to the number of compounding periods. So FV equals PV parentheses 1 plus I to the n power. So how the number of compounding periods makes it a bigger number because that's the exponent, and the interest rate, of course, would have an impact on it as well. So a problem that's listed in the PowerPoint is at the time of your birth, your aunt deposited $10,000 for you into an account earning $5,000 annually. How much money will you have on your 18th birthday? How much money would you have by the time you turn 30? And how much money would you have the time by you turn 65? So looking together, $10,000 at birth, earning 5% annually. At age 18, the FV would be $10,000 times 1 plus 0.05, which is your interest rate, to the 18th power, because you're doing it 18 times. FV equals $10,000 times 1.05 to the 18th power, 10,000 times 2.41, you'd have $24,066.19 on your 18th birthday with just putting that one lump sum in. If you let it ride until you were 30, same thing. It's you just up the exponent to 30, and you would have $43,219.42 by your 30th birthday. And if you let it ride until you turn age 65, again, you just up the exponent to 65, and you would have $238,399.01 on your 65th birthday. So that's just letting it go, letting it ride. There is a table, the future value interest factor table. So you can kind of use that and to help you with some of the problems. It's in Appendix A of the textbook. And so you can use that instead of doing the longhand. It's future value equals present value times FIVF, the table, I to the N, which is 10,000 is the present value, FVIF, whatever the table says, 5%, 18 compoundings, 10,000 times 2.4066, $24,066 on your 18th birthday, which is off by 19 cents from the longhand division, or the longhand method. So you're off just a little bit, but it's a good rounder. So you can also use a calculator, and it depends on what your calculator does, but you just punch in the value of present value is 10,000, interest per year 5%, N is the number of years, and hit future value equals $238,399.01. So they changed it and looked at a different interest rate, give you a little bit more money, $1,023,342.42. And you do the reverse in present value of a lump sum. It's the reverse of compounding. You find the present value of a future amount by deducting the interest. Present value equals future value divided by 1 plus I, which is the interest rate, to the N power, where N is the number of time periods. And so if you want your newborn to have $10,000 at age 18, how much would you need to give them now, assuming 6% interest? So we're doing it backwards, basically. So longhand method says present value, you want $10,000 in 18 years. Present value equals future value times 1 plus interest rate to the nth power. 10,000 is what you want to be in 18 years at 6% interest, divided by 1 plus 0.06 raised to the 18th power. 10,000 divided by 1.06 to the 18th, 10,000 divided by 2.85. Your present value, in order to get $10,000 at 6% interest in 18 years, you need to give $3,503.44. So it's doing it backwards. It's just doing the exact same thing. It's just dividing so you get it backwards instead of forwards. And there's a table for that as well. And just like with the future value, it's a little bit off, but it's not bad. It's a few cents off. And it shows you how to do it with the calculator as well. Then they talk about annuities. An annuity is a stream of equal payments that occurs at the end of a period. And that's an ordinary annuity. Like if you win the lottery, you can get it in payments. And so basically with an ordinary annuity, it starts like at the end of the first period. So like, let's say I win it on January 1st. I would get my first annuity payment on February 1st, and it goes forward. An annuity due is I win it on January 1st, I get it on January 1st, and then it stops 1 month early. It's either you get it at the beginning or the end of the month. It's kind of interesting. It's the beginning or the end of the period. And they show you how to calculate that. Future value of an annuity equals payment. And brackets. And then, parentheses, 1 plus I to the nth power minus 1, close brackets, divided by the other I, the italic I, in fancy brackets, where FVA is the future value of an annuity, the payment, PMT is the payment, the I is the interest rate, and the N is the number of time periods. And so your parents want to contribute to your child's education. They plan to contribute $500 each year for 18 years. How much money will your child have after 18 years at 6% interest? That's the future value of an annuity. 500, fancy brackets, plain brackets, parentheses, 0.06, parentheses, 18 periods minus 1, plain brackets divided by 0.06, fancy brackets. Whoa, that's a lot. Basically, what they're saying is at the end of that, all of that, you're going to get $15,452.83. And there's a table for that. And then it shows you how to do it on a calculator. And the annuity due is the same thing. It's just you start at the beginning of the period instead of the end. And then they do a retirement scenario and an auto loan payment scenario. If you have any questions, please contact me about it. We can go through it, but I feel like a lot of this is repetitive. Once you get it down, it makes a lot of sense. And then it talks about some goals and stuff like that. And that is chapter 4. So, recap, right quick. For this week, chapter 3, chapter 4. The problems, there's always 5 problems for each chapter. A chapter quiz with 10 questions each. A continuing case scenario for each chapter. And this week you have test number 1 and your discussion board. Hope this took a long time, but I think it was worth it, and I will see you next week. Next week we'll be looking at chapters 5 and 6. Thank you. Goodbye.